Well, welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 88. On today's episode, we're going to discuss the efficient market theory. What is the efficient market theory? What does it mean? Is it true? Is it not true? It's a timeless debate between academics and practitioners. And so I want to give my unique opinion on this as somebody who is in both worlds, so to speak. So I hope you'll join me. Get your mind right. Let's get to work. All right. Well, welcome back to the show, everybody. I appreciate you joining me for another week here, and we'll discuss the market. This past week, a good week for the market. The first of the week was not good. Again, I'm not going to spend a whole lot of time on this because the market just keeps oscillating between good inflation, bad inflation numbers. If we get good inflation numbers, the market goes up. If we get bad inflation numbers, the market goes down, and we're just kind of seesawing around here. And so kind of refuse to discuss that every single week. But you do have to kind of think about, I use it as an opportunity, if there's positions I want to be in, I'm using this as an opportunity to be able to buy back into them and to kind of build out my positions that I think are going to do well over the next couple of years. And so really, I look at it from that angle when I'm investing for myself or clients or whomever. I'm like, okay, the decisions that we make today, being a little bit braver today, I think is going to pan out very well in the next 3 to 5 years. So we'll see how that goes. A perfect example of that would be Tesla this week. So Tesla had their investor day on March 1st, and the disappointment was that they didn't come out with a new body style. Everybody expected them to do a new body style for some of their older models, kind of a redesign that you see most car companies do. And they didn't announce that. They did announce that they're going to build their biggest gigafactory in Mexico. But the analysts were upset that they didn't announce a new body style. So the stock sold off. It went from about $210 down to, I believe, $190. Actually 188, 189. And then the next day it came out that their sales numbers in February were better than expected. And so then the stock immediately came back up. And so those are the kind of opportunities that you have to look for when you're looking at, okay, these are the companies I want to be invested in. These are the core companies I want to be invested in. And how am I going to build out those positions and use this as a way to improve my portfolio. So I thought this would be a good, just based on what the market is doing right now, to give some controversial opinions and teach you a little bit today about the efficient market theory. So the efficient market theory is a theory that states that all the information about companies is in the public realm. And so because of that, all stocks trade at their preferred valuation, right? Like basically saying that you're never going to be able to beat the market, that you're never going to be able to have a better performance than the market because the market is perfectly efficient. All available data is in the public, and there is no way for you to kind of get an edge on the market. And so you're better off just putting all your money into an S&P 500 index fund or, using index funds and never really trying to beat the market on your own. That's really what the efficient market theory says. And so, if you're somebody who doesn't want to watch the market, if you're somebody who doesn't want to do homework, if you're somebody who doesn't want to put in the work, which is fine. I mean, it's totally fine. Then yeah, an S&P 500 index fund is probably going to be the best thing you could ever do. But for those of us who, study this all the time, are really looking at companies, looking at fundamentals, analyzing these things, I can tell you from somebody who has been an academic and somebody who has been a practitioner working with individual clients that there is no way that you could ever convince me that the market is absolutely efficient. Like I am totally in the camp that the market is not efficient. And by the way, this has had real ramifications for me in my academic world, right? Like there are times where I have interviewed for jobs and for finance professor jobs, and the question has been, do you believe in the efficient market theory? And my answer has been no. And then I proceed to get absolutely grilled from pure financial academics on why I'm wrong. And then I just know, like, okay, this job interview is not going well. There is no way I'm getting a call back. And these are some of the top business, like these examples, I'm not going to name names, but these are some of the top business schools in the country that I've had these conversations with. And not only do I not get a call, like some of them, not only did I not get a call back, I didn't even get a call back telling me that I wasn't going to, like, I didn't even get the rejection call. Like I just did not get a call at all. And so, pure academics really believe in the efficient market theory. They believe that you cannot beat the market. But for somebody, if you've worked with real investors, retail investors like I do, advising people on their money, I don't think you would ever think that the market's really efficient, because we as humans make terrible decisions when it comes to investing. We let our emotions control our behavior. And we you hear the old adage that you should buy low and sell high, but so many investors buy high and sell low. Like they get scared, they panic, and so I really think that there has to be some thought on this, and that sometimes we are our own worst enemy. So when you look at some of the mistakes that investors make, and I've mentioned it on this podcast a number of times, that people trading their accounts too often is the number one mistake that they make. And normally when I say trade too often, I mean, they're not making just buy orders the whole time investing, right? They're buying and selling, and then they buy it back and then they sell it. And, when you start looking at the data on, missing the best days in the market and how it impacts your performance, most of the time, the best days in the market come within two weeks of the worst days. And so what ends up happening is you have a really bad day and somebody sells out, and then there's a good day and they put back, they invest back in, and they end up missing, a couple percentage points. And so, the efficient market theory to me is, it really loses a lot of the credibility when you start looking at, when you just start looking at normal retail investors. And so that's kind of, me as I would consider a scholar practitioner, somebody who's on the academic side, but also, more so a practitioner. It becomes very difficult for me to buy into that, because I just see the mistakes, and I've seen the mistakes that people make over the years. And the other thing about that is, the efficient market theory says that, all the data is out there. And so, the market's efficient because all this data is in the public realm. Well, the thing about that is that, the number one thing is that people can look at the same data and draw different conclusions. And it's one of the reasons that I really enjoy, behavioral finance, is because let's say you have a parent that, passes down, financial advice or money advice or whatever. It doesn't even have to be financial advice. Like you have a parent who, says the same thing to two different children, and the lesson is completely different, right? They take that information differently. I mean, I'm sure many of you listen to this, you have a brother or sister or, somebody in your family that thinks exact opposite of you or different. You're like, man, we got the same lessons. How are we have the exact, different opinions on this? We don't see the data the same. Well, it's the same thing, right? So as you look at investing and you look at data that comes out, and somebody will go, oh man, that's positive for this company. And somebody else will go, no, that's negative for this company. So even though the information is out there, for the public to have at, we draw different conclusions based on that data. So, it makes it so there are going to be times where the stock market is overvalued, and there are going to be times when the stock market is undervalued, and companies don't trade right at their what the value of a company is. And it's amazing. You see it right now. Back when the market was hot in 2021, before we had this big sell-off, Amazon was trading at $176 a share, and everybody wanted it. They couldn't have it. They couldn't get enough of it. Now Amazon's trading for $94 and nobody wants it. Right. So, there are times where the market's going to be overvalued, and there's going to be times when the market's undervalued, and it can stay overvalued longer than you expect it to, and it can stay undervalued longer than you expect it to. I mean, these are the things that happen, over your lifetime when it comes to investing. And so, there are times where stocks, even though new information comes out, it could take a while for people to notice. I think especially in today's stock market world, there is so much data, so many news articles that come out that it's almost impossible for us to be able to comb through it all and digest it for every single company that we're following. And even now, I mean, they're starting to have AI write articles for, investment articles on different companies. And so, it's just this data that we, there's just so much data that it's almost impossible to comb through it. And then you also have just human error and emotional errors that we make. One of the main things when I'm talking to somebody new that's learning to think, thinking about investing, and they're kind of like, what are some tips thinking about investing? Well, one of my biggest ones that I like to discuss is that if you're going to invest in a company, you have to think about what you're going to do if that stock goes down or up, right? You have to think about what are the actions I'm going to take if I buy this company today, if I buy this company today and it goes down tomorrow, what am I going to do? Am I going to sell it? Am I going to buy some more? Am I going to dollar cost average? If it goes down 10%, if it goes down 5%, what happens if it goes up? If it goes up 5%, 10%, what if it doubles in a month? What am I going to do? Right? And you want to make these decisions before it happens because you don't want your emotions to betray you. Because if you invest in a company tomorrow and then 2 days later it starts to go down, you're immediately going to feel anxious. Whereas if you thought it was a good deal at whatever price and it drops, instinctively, if you really believe in that company and the numbers of that company, you should actually be thinking, okay, I'm going to buy some more shares. But that rarely happens. For the average retail investor, they start to lose money, they immediately sell out of it. And so that creates tax consequences. That creates, maybe a wash sell in the future. If they buy the shares back, they're not able to take the loss if they buy it back within 30 days. We did a whole episode on that, on wash sells. So, there's different things that you have to do, but, that will always be the case. Human emotion, human error. There are always going to be times where, we get exuberance from greediness. We saw that with memes and crypto and all that. And there's going to be times where nobody wants to own anything, and they would rather put their money in a CD and not have the volatility of the market. And we're seeing that. I mean, with rates going up, and you can get a CD for almost 4.9%, almost 5%. You have so many people who are just saying, I don't want to be in the market. I want to get out. I'm going to buy these CDs. And then later on, the market will start to do better. They will cash out of those CDs and they will start investing back in the market, but they're going to miss kind of the low. They're going to wait and see until the market gets better, and then they're going to come back in. And that's why, lately, that's why I'm trying to do for myself is invest as much as possible, build up shares in good companies, because I know that later on when the market comes back, it's going to be that much more beneficial for me as all this money from the sidelines starts to pile in. So I'm kind of like, okay, I got to use the next so many months here to really get after acquiring shares. So this isn't something that's new, this efficient market versus regular stock market. This efficient market theory is not something that's new. There's a great article, and I try not to quote him too much, but it just becomes ridiculous. But Warren Buffett wrote an article called "The Super Investors of Graham-and-Dodsville." And in the show notes, I'm going to put a link to this article that you can go read, where it was kind of when this really started to get popular. Somebody, a lot of academics and these efficient market theorists would come out and say, okay, yes, Warren Buffett has done well as an investor, but honestly, if you just took, he's one guy out of 200 and whatever million people, and really, if you took a monkey and had them pick stocks, one of them would be better at it than the others. And so obviously Mr. Buffett took offense to this. And so he ended up doing an article, and it's called "The Super Investors of Graham-and-Dodsville." And unless you're pretty much an investment nerd, you probably haven't heard of this, but it's a great article that outlines, kind of, he pokes fun of it. The start of the article talks about, okay, let's say we had everybody in America, and at the time, there was, he used the example 225 million. So let's say there's 225 million, and they're going to flip a coin. Everybody's going to come out onto their front lawn every single day. They're going to flip a coin, and if they're right, they're going to keep moving on throughout. Every single day they win basically, and everybody starts with $1. And you win money as you go. Well, after 10 days, there would be 220,000. So you'd go from 220 million. After 10 days, there'd only be 220,000 people that had correctly called 10 flips in a row. And after 20 days, there would be 215 people. And this is where it kind of gets funny, because he talks about, okay, there's 225 people here, and now they're writing books about, their flipping strategy and, why they can flip a coin so much better than others. But then he said, okay, well, what if we found out that all of these people came from the same place, right? So they weren't just, maybe it's not that random. What if they all came from the same place? And then later on in this article, he goes and he looks at the records of all the people that worked for, Graham and Dodd like he did back in the 50s, and he goes and tracks their career. And yes, he might be the most successful one, but it turns out that all of these people that were value investors that were trained by Ben Graham, they actually all outperform the market as well. And he says it's not as random as you might think, right? We're all employing the same principles. Maybe some of us are a little bit more skilled, but we've all outperformed the market because we're actually looking at these companies as businesses, and we're making these decisions as, on the principles that Ben Graham set forth. And so it's a very interesting read. I think it does a great job of kind of outlining this, and probably does a much better job articulating it, much better than I can. The interesting thing about this article, did it come out 10 years ago, 5 years ago? No. This article came out in 1984. Right? So he was getting so much pressure back then. And I find that fascinating that you can look at it now. He wrote this in 1984, and he's still been able to outperform. And so you look at Warren Buffett, you look at somebody like Peter Lynch, who I have not talked enough about. Peter Lynch was an incredible investor as well, especially back in the 80s when he ran the Fidelity Magellan Fund. And in the future, I'll do an episode on Peter Lynch and kind of his investment style. Because I feel like mine is definitely a kind of a merger between the two of Buffett and Peter Lynch. And so, but it's a very interesting article that shows, and one of the reasons academics hate this article is because he talks about all the things that we teach in business school. Capital asset pricing model, all these different things, covariance, beta, like all the things that a lot of investors use or a lot of academics use. And he basically, not all of them, but he basically says a lot of them are kind of worthless. The capital asset pricing model, I mean, this is getting way too granular. It's not, I don't really enjoy it. You have to make up a lot of numbers. You have to make up a lot of numbers in order to use that. And for me, that's just not even like, I mean, it's kind of a waste of time. And so when you look at things from a fundamental basis, is this a good business? Is this business, does it have, the protection of a moat from competitors? Is it something that can be used long-term? Is it something that's not going to be impacted by technology? Are they going to be able to charge more? If there's inflation, will they be able to raise their prices? Will people still buy? Like all of these foundational, fundamental things, still hold true that you can make good investment decisions. And as long as you're willing to be patient, hold these companies for a number of years, you're going to do well in investing. And in some cases, you can even outperform the market while doing so. And so for me, the efficient market is not something I pay a lot of attention to because I 100% think that there will always be investors that will act irrationally and they will let their emotions get the better of them. And that if you want to outperform the market, having the right emotional stability and just kind of understanding how the market works and understanding that good people will let their emotions, betray them and they will sell when they shouldn't. And that will allow you to buy and invest in good companies at great prices that if you're willing to hold them, you can do very, very well for yourself. And so, that is one of the hardest things to, I guess you don't really learn it. You just have to learn to deal with emotions. You just have to learn how to kind of be aware and conscious that your emotions are going to kind of be on the fritz when the market isn't doing well. Like it's one thing to look at a stock chart. I didn't say that properly. It's one thing to look at a stock chart and see it go down and then see it come back up. And you're like, okay, I could handle that. I see that on the chart. I could handle that. No problem. The market recovered. But when you're going through it, when you're in the middle of it, it's completely different, right? It's very scary when you see the market going down and there's bad things on the news and all that. But you just got to take a breath, think about the companies that you're invested in and go, is the things that are going on today, is it really going to impact this company long term? Why did I invest in this company in the first place? Are those things still there? And do I think the company is going to be able to weather this storm? Right? And if something hasn't fundamentally changed with that business, and the answer is yes, you have to say, okay, this might look ugly on paper. It might look like I'm losing money right now, but I know the best thing for me to do is probably buy some more shares. If I really believe in this company, I'm going to buy some more shares while it's lower and I'm going to be patient. And later on, I know I'm going to be right. And so much easier said than done. I will admit that it's easier said than done. But for all practical purposes, if you can control your emotions and if you can be aware of this, you will intrinsically know that, okay, I know everybody else is being irrational right now and I need to be aggressive. Right? I need to be aggressive and invest as much as possible while others are being irrational and selling good companies because they're scared. Right? If you can do that, you can become very wealthy and you will have a much better time investing than most people. So I hope this was helpful for you. You can download this article in the show notes and read through it. I think it'll be a very good piece of knowledge for you to look up and read. Most people, most investors, most people you're going to talk to have never read this or heard of it. So this is a way to, again, increase your financial literacy and just kind of improve yourself overall. So I appreciate you joining me. Don't mistake activity for achievement. I'll see you next time. Thanks, everybody.